Imagine purchasing a life insurance policy to secure your family's future only to discover that similar policies are being exploited by criminals to launder illicit funds. This alarming reality highlights the critical needs for robust anti-money laundering compliance also within the insurance sector, and that's what we are going to talk about in today's video. So let's jump right into it. Welcome back to FinCrime Agent. I'm Marco Beranzoni, a financial crime prevention specialist, and today we are covering the role of AML compliance in the insurance industry. By the end of this video, you will understand why AML compliance is essential in the insurance sector, the specific money laundering risks that are associated with insurance products, and how insurers can implement effective AML measures. But before we dive deeper, if you're looking to advance your career in financial crime prevention, check out my FinCrime Career Accelerator course. It's designed to equip you with the skills that are needed to excel in this field, and you will find the link to it in the description right below. Okay, so let's dive deeper into why AML compliance in the insurance sector is not just a regulatory box-ticking exercise, but a critical safeguard for the entire sector. First of all, insurance products, especially life insurance, annuities, and investment-linked policies, are attractive to money launderers. Why? Because they combine financial value with flexibility, often allowing early withdrawals or cash surrenders. Criminals exploit these features to convert illicit funds into seemingly legitimate payouts. Here is an example. Imagine someone purchasing a life insurance policy with a large single premium payment. After a short time, they cancel the policy, willingly accepting the financial penalties, but what's the outcome? They effectively launder dirty money through a regulated product and becomes less suspicious. More clean-looking funds is the actual result. And this is one more reason why AML compliance in insurance is so important. It protects not only the integrity of the financial system, but at the same time the reputation of insurance firms themselves. No company, of course, wants to find their names in a headline because of a policy the issue was then used to launder drug money or fund criminal activity. Now let's talk about the specific money laundering risks associated with insurance products. According to FATF guidance for the life insurance sector, certain policy features create vulnerabilities. For example, early policy surrender is a major red flag. When a customer unexpectedly cancels a policy and requests a payout, it could signal that the policy was used as a temporary parking spot for illicit funds, the example we talked about before. Another is overpayments followed by refunds. This happens when someone intentionally pays more than the premium that is due and then asks for the excess to be refunded. What's the goal in that? Get clear money back, potentially even from a different account. Another one is unusual premium payments, large sum paid through cash, multiple small transactions, or from offshore accounts without a clear link to the policyholder. Policies inconsistent with a customer's profile is one more. For example, a young student buying a high-value life insurance policy with no logical reasons or financial capacity. What makes this risk trickier is that many customers genuinely buy insurance for perfectly legitimate reasons, and that's why insurers must carefully distinguish between normal client behavior and transactions that actually raise suspicion. So how can insurers implement effective AML compliance measures? It all starts with a strong risk-based approach. Not every product carries the same risk, and not every customer is a potential threat. For instance, simple term life insurance may pose less risk than investment-linked policies with cash values feature. And here are key steps that every insurance company should be taking. The first one is robust customer due diligence, or the CDD approach. At onboarding, gathering sufficient information to understand who the customer is, the source of their funds, and the purpose of that policy. For higher risk customer, like politically exposed person, enhanced due diligence is a must, as we have seen also across many of the space in financial services. Number 2, ongoing monitoring. AML compliance in insurance doesn't stop at the onboarding stage. Continuous monitoring is still essential because insurance should track premium payments, policy changes, and payout requests. Suspicious patterns like repeated early surrenders should trigger, in fact, internal reviews based on this type of monitoring. Point number 3 is red flag training. Employees must be trained to spot suspicious activities. For example, if an agent notices a client insisting on paying in cash or pushing for a refund to an unrelated third-party account, that's indeed a red flag they should be knowing. Number 4, clear reporting mechanism. Insurers need to ensure that when suspicions arise, there is a clear pathway to file a suspicious activity report with the appropriate authority, of course. Delays or failure here could expose the company to hefty fines and also reputational damages. Number 5, governance and accountability. This is probably in place by most financial institutions. However, it's worth remembering the importance of assigning a dedicated money laundering officer with the authority and resources to oversee the AML program. Additionally, periodic independent audits should be done in order to understand that systems are effectively working as expected and apply the relevant improvements when these are needed. Number 6, leverage technology. More insurers are now tuning to advanced analytics, machine learning, and AI-powered tools to enhance the AML compliance framework. These tools help detect a pattern that manual review might miss, of course, like connections to sanctions, maybe high-risk jurisdictions exposure. It's also worth noting that global regulatory expectations are increasing. So just last year in the EU, we've seen an highlight on importance for including the insurance sector in the AML package, reinforcing that insurers play still a vital role in the fight against financial crime. FATF also indicated that the insurance sector must remain vigilant and tailor AML measures to protect risk, ensuring that risk mitigation is effective without unduly hampering legitimate business. There is also a FATF guidance that you can refer to, titled Guidance for a risk-based approach in the life insurance sector, and I'll leave you a link in the video description right below so you can read it in full at your own time if you want to go deeper into this topic. But this guidance underlines that AML compliance in insurance is not optional. It's a fundamental responsibility, and let's face it, the cost of getting this wrong is really high. Regulatory fines, as we know, reputational damages, and the potential loss of customer trust are consequences that no insurer can afford. So before we close this video, let me ask you this. Have you ever thought about how much personal data you share when you buy a policy? Your names, address, income details, all of these can become part of a money laundering scheme if the insurer's AML control are weak. That's why every professional in this industry need to understand the risks that are connected to it. In summary, while the insurance sector may not be the first industry that comes to mind when discussing money laundering, it's imperative for insurers to recognize and address their unique vulnerabilities. By implementing a comprehensive risk-based AML program, insurance companies not only comply with global standards but also protect themselves and their customers from being exploited by financial criminals. And if you found this video helpful, press the like button and make sure to subscribe for more insight into regulatory compliance and financial crime. And that's all for today. Thanks for watching and see you soon.